How you can buy 5 properties in 2 years with only $150,000. Well, it's actually not as hard as you think. I've helped thousands of clients do it. And I've used the exact same strategy to buy over 150 properties myself at just the age of 33 years old. So in this video, I'm going to break down the step-by-step process to buy 5, 10, or even 20 investment properties with only $150K starting point. By the way, if you want even more detail on exactly how this process works, you can use a link in the description to download one of the free ebooks, How to Buy 10 Properties Fast or 30 Properties Before the Age of 30. In this video, we're going to be talking about different styles of properties. And when I say property, some people automatically think as a house. But in Australia, especially if you live in Sydney or Melbourne, houses can be very expensive in certain locations. And what's very, very exciting about this, I'm going to use real life examples of properties and give you the addresses of these properties that clients have bought, properties that I bought, so on and so forth. And I'm going to use those real life examples of properties in this video, which is super exciting. Point 1. I'm a value investor, so I do things very against the grain, contrarian to what normal people do. I want to buy properties that are below market value or below bank valuation. I'll buy a property as an example that's $500,000 and I'll only buy it for $500K if I've got a broker on the side or a bank on the side prior to purchasing it that has told me, yes, this is worth $600,000 by this bank, XYZ bank, maybe even 2-3 banks, but they valued it at 600, 650, so I know I'm making 100K, 150K on the way in. Next thing is, I'm buying in at relatively metro locations. You'll see the examples that I'm going to show you in this video in metro locations such as Sydney, Melbourne, Brisbane, Perth, whatever. I usually buy within 30 to 45 minutes, maybe an hour, worst case, of a capital city. I'm not saying do not buy further than that, but I'm just saying those ones I usually stick to, right? The next thing is yields between 5 and 10%. Usually, people in the past have said high cash flow, positive gearing, all that bullshit. I don't refer to it as positive gearing anymore because there's too many things involved, too many variables. Yields between 5 and 10%. The higher you go, the better it is, but you will get a different type of property the higher you go in terms of yield. You're not going to have a massive house with a 10% yield that's in a metro area. It's unrealistic. Our last thing is I want to cycle upside. I want to buy a property in a market which is about to explode. I want to buy a property that basically, maybe it's been flat for the last decade. If you know these cycles, and if you've seen from my other videos about this, markets go in cycles, and if you time the market effectively, you can pick up a property at the bottom of the market. Everyone will say you're crazy, by the way, if you try to do this. But I've done it time and time again. I did in Queensland, did in Adelaide, did in Perth, doing it in Sydney, Melbourne, etc. I buy a property after a market's been shit for quite a long time, and then bang, it takes off, and then all the properties that I buy usually double within 2 years, 1 year, 3 years, or whatever it may be. You might be wondering why and how you can get properties that are undervalued is point 1. How about we talk about bank repossessed properties? Bank repossessions happen every day, every week in Australia. There's 7 units. I'm buying 1. Clients are buying the other 6, and we're splitting them all up and we're getting a mad deal. Where these on average are we're picking up about $379 a piece, and they're worth like $470, $500K at least. Back to it. Bank repossessed properties, you can get a bargain if you buy a bank repossessed property. Sometimes, I'm not saying that they're all property you buy that's a bank repossessed property will be a bargain. It could be, depending on many factors and how and well you negotiate it and so on and so forth. Off-market properties, we buy properties every single day of the week that are not on real estate or domain. Obviously, if you're buying a property that is not online, there's lower competition out there. There's a lower amount of people that have access to it. And the more people have access to that property, the more the price explodes through the roof. So off-market property, you can get really, really good deals. Next thing is access issues. Access issues to properties. If there's a tenant in place and on a fixed lease, it's hard to get through. The harder it is to show a particular property every single day, have an open home every day and show 100 buyers through. Whereas if you've got access issues and the tenant's in there as an example, and they won't allow you to show the property maybe only once every 2 weeks, it makes it harder to sell that property. The harder to sell it as a property, the lower the price goes. Next thing could just be a bad agent. I've negotiated 10,000 properties, maybe more in my lifetime, probably more. I've dealt with agents that are very, very good and they know what they price the property really well. And I've dealt with agents that could be better and they've already put a property on the market. They've done their own comparable market analysis and they've put it on the market and it was under what I believe was already worth. Same old story. You can have 4 different agents go to one property and one will say it's worth $1 million, one will say it's worth 1.2, and one will say it's worth 900. So there's always a variance. Sometimes they don't even know. It could come down to a lack of experience. It's nothing against the agent, but like I buy properties where I can smell and see value and I want to be able to get the best possible deal and make money for whoever's buying a property. Seller direct. I bought properties directly from sellers before. I bought properties directly from sellers, but there's no agent involved, and the seller's basically, I want this price, and they just think it's worth that, and then you were able to get it at a steal, 100, 200, 500 grand under what it's worth. Next thing is badly marketed properties. So many times I've, occasionally we'll buy properties that are online, and so many times ones that are badly marketed. They misrepresented. They have terrible photos. They have terrible, floor plan, doesn't have a floor plan at all. They have terrible description. They're saying it's a 2-bedroom property when really it's like a 3-bedroom. They've missed an entire bedroom before. Bathrooms, they're putting the wrong square meterage, external versus external, 1,000 things. Marketing can have a play and push the price up and down. And lease issues. Lease issues probably covered by the access issues, but lease issues, I've bought properties personally that no one else wanted to buy because it had a long 2-year lease in place, right? And it was only rented for 500, what it should have been rented for 800 a week. So a lot of other buyers were like, I don't want to hold this property. It's negative, $300 a week for the next 2 years. I'm going to lose 15 grand. And that cut the list of buyers that were willing to buy it. And because of that, I was able to buy it 100K under what it was worth. Not that the seller knew that at the time, but I was able to get it what I believed what it was under was worth. Then I ordered a bank val, and that only proved my point that was worth more than that. We've got the type of strategies that I'm doing, which is why you can buy a property that is actually under what it's worth. We're starting with 150,000 in this scenario, right? Let's assume you're a young person in your mid-20s as an example, or mid-20s, late 20s, or you're in your 30s, whatever it is. You got 150K in the bank, and let's assume that you're able to save $500 per week. Now, for this example, let's assume that the person knows how to invest in property. They've got the level of skills, knowledge to be able to go out there and buy properties that are in line with these strategies, right? That's why I put all this free information out there so people can learn what I've learned over the years. Is these YouTubes are absolutely free. I don't get anything from it, but you can take this information, learn knowledge, and you can either do it yourself or you can come to us and we can help do it for you. You can work with myself and my team one-on-one, and we can get you these amazing bargains. For this example, let's assume that the person just knows how to do it and they're doing it themselves, or they're coming through us. Either way. So you got 150,000 as an example. The first property that the person buys, I don't know if you can see that there, 395,000. This property, I'm going to give you the address. It'll probably pop up on the screen, but it's basically a 2-bedroom, 2-bathroom, 1-car unit style property in the suburb of Cloverdale in Perth on Hendra Street. Now, this is a real life example we bought for clients. Hopefully the date will pop up around. We bought this property. It was a bulk deal transaction, bought it for 395,000. In this scenario, let's assume that the person did a 10% deposit on that, 10% deposit of 395K. There's different banks out there. Even, the major banks now, they will allow 5% deposits. I won't say the names out there, but, Black and Yellow and all these different banks, and even smaller 2nd tier and 3rd tier banks allow 5 and 10% deposits. So you don't have to do 20s. I'm not an advocate for saying do 5s and 10s. I'm just using them in this example, all right? 395,000. Let's assume they do a 10% deposit. The stamp duty on that is about 12 grand, 2 grand for legal fees over right there. And let's say 4K roughly for LMI. Let's say they're into this property and they've got the 150K right here starting off with, and they just spent $58,000. They bought the first property. Hooray. Now, let's assume, and I forgot to tell you, we've got a timeline right here. Every 3-month increments. So right here is year 1, right here is year 2. The clock is ticking. How are we going to get to 5 properties within 2 years? Surprisingly very easy. 58K, 1 property down, 4 to go. Number 2, we go back, we buy another property. This property right here is 379K. All right, a little bit bigger so you can see it. 379K, this property is a property that we also got as part of a bulk transaction. I spoke about it not too long ago. It was a property in Guildford, and it was a bank repossessed property. 379,000, 2-bedroom, 1-bathroom, 1 car, comparable properties literally at the time in the same block and on the market for 470 to 520,000. I'd say banks literally value this at about 500K right away at purchase. They're settling within the next 2 weeks of this video, right? I'm buying one myself and 6 other clients are buying one, right? And you can do your own, research if you want to. Out of this 379, let's assume this one, we got a bit creative. We went to either a 3rd-tier lender or one of the big banks, because a couple now do it. We did a 5% deposit. 5% of 379,000 is, let's round it up to $90,000, 12K worth of stamp duty. I did done the figures already. 2K worth of legal fees. and roughly 6K miscellaneous buffer, LMI, etc. So we're into that for 49K, right? For 58K plus 49, we're up to 107,000. We've only got literally 43. But let's assume we bought property number 2. And by the way, guys, you could take this property that we bought for the client, 395 industry. They could have got equity out right away. But let's assume they don't get equity out for an entire year. Let's assume they don't even do that. So this video is so conservative. Like, I could probably show you how to get to 10 properties within 2 years, just like the other video showed you how to get 10 properties in 3 years. But I want to break it down and try to make it as simple as possible for you and give you something very tangible to be able to work with and be able to aim towards. All right. Now, we've bought the 2 properties. We got 3 to go. And let's assume that that literally only took us 9 months as an example. So we're right here now. We're right there, 9 months down, 2 properties in. We've only got a little bit longer to go. Let's remember, during this period of time, we're saving $500 a week. Now, during that time, let's say 6 months, $500 times 4 times 9 months as an example, 18 grand. Let's just say we've got an additional 18 grand, 43 plus 18,000, 61K. So we've got 61K still left in the bank. We buy another property. This is 395,000. And now we're buying a 2-bedroom, 1-bath, 1-car property in Melbourne, suburb of Northcote. And I'll give you the address. These are real life examples as well that we bought for clients. I bought one and we split up and did a bulk deal transaction. 395,000. Let's assume this one as well. 5% deposit. Go to another bank. Again, if you're just joining me now, you can do 5% deposits in Australia for investment properties. You know, there's like 5 to 6 different third-tier lenders that do it, and a few big main-tier lenders do it now as well. With that scenario, you could have done a 10% deposit. Well, we'll just go 5%. 5% of 395, let's just round it up. I'm rounding it up in these scenarios. 20K, stamp duty is a little bit more in Melbourne, so we'll round it up to 20K. Legal fees, 2K. Miscellaneous buffer, LMI, 2K. So we're into it. We're for about 47K, and we still got about $14,000 left. 61 minus 47. Let's just say $14,000 left. But we bought the property. Let's go out and harvest and get the cash out of the properties. Real life example again. Bought it for $395. This one was literally sold about 12 months ago. So we're right now, let's say we're at the 1 year mark, which literally, as of this date, the client bought that property and it was a year ago. And these are 570,000. Here's the fun part. The original loan against the property, right? The old loan is 356,000 because we did a 90% loan, 395 times 0.9 with 90% loan is 356,000. Now, we've got the property valued at 550,000 now, which is the legitimate value. And this is a legitimate, example. So now we're going to go back to the bank and do a top-up refinance or a side loan up to 90% of the new value. You can do that if you go to the right bank and you know the right broker. Some banks will say you only take it up to 80%, but yes, you can go up to 90. I've done it before myself multiple times. If someone's telling you can't do it, they don't know what they're talking about, and they obviously don't own 150 properties like I do. New value 550. That basically makes the loan go from 356 to 495. Yes, we are topping up the loan. And before you go to get into it, I've got a cash flow with use questions. Oh, but Eddie, then it's going to change the cash flow and I'm going to be paying extra money. It's going to be more negative gear and negative cash flow, whatever it is. Stick around to the end of this video because I'm about to bust that myth as well. And I'm about to show you how this can all work and how everyday Aussies are building massive property portfolios like this, making millions, cash flow, equity, peace and love. Yes, they topped up the loan, but what is the difference? So if you don't know this, there's other videos basically to do it, but you can do a cash out, refinance, you're taking the cash out. Because you bought it for 395, now it's worth 550. The old loan was 356. The new loan, which is 90% of the new value, basically you take your new loan minus your old loan, and then you get the cash out difference. In essence, 495 minus 356, hope my numbers are correct here, equals 139,000. Cash out, bang, right in the bank, right? So we've got 139K back in the kitty. Next point right here, we go back, we got an evaluation of 500,000, and this is literally this property that I'm giving you the actual address for is going to settle a few weeks, and I'm literally going to go back and get it valued at 500K because I already know the valuation came back with certain banks at 500K. Again, valuations can vary. One bank can say 500,000, another bank can say 470, another one can say 520. You do what you will with those types of valuations, and you use them to get yourself to where you want to be with building your property portfolio. Bought it for 379, literally got it valued at 500K. Now, we bought this one with 5% deposit. So the loan based off 379 was around 300. The loan is about 360,000, but we just got it valued at 500,000. So now let's assume the bank says for this particular one, you can only take the loan up to 80%. Let's be a bit more conservative with this particular property. So you can only take the loan up to 80% now, not 90 or 95, what it originally was. Now, the new value is 500,000, as you can see. What is 80% of the new value, 500,000? And that is, I've already worked it out, $400,000, right? So that's 80% of 500K. Now, the old loan was 360,000, roughly that. So we take the new loan of 400K minus the old loan of 360,000, and we're able to get out $40,000. So we're at 193K equity before, because we had 139K, we had some savings at 153K. Now we take out another 40K, or at 193,000 cash in the bank, and we've got 3 properties. How awesome is this? Now, let's jump to property number 4. This is another property that we bought on behalf of a client. Her name is Michaela by memory. It was a townhouse in Melbourne, about 35 minutes from Melbourne, but modern townhouse, 2-bedroom, 2-story, 1-car garage, undervalued. You know, just getting these properties now at value to roughly 430,000, and that was only about 6 months ago. 355,000 bought it for. Did a 10% deposit on this property. You can probably see that's 36,000. I'm just rounding up again. I'm being even more conservative. 36,000, 10% deposit, 18K stamp duty, 3K legal fees, another 3K for LMI. In some cases, yes, you can put the lender's mortgage insurance on top of the loan and they capitalize it. In these scenarios, I know I haven't been talking a lot about LMI, but I'm going to make up for it at the very, very end. So hang on there with me. Let's assume, that we're at this point right now, we're at 13, 14 months. We're still not even there. Plenty of time up our sleeve to do other stuff. And that cost us roughly $60,000 in total. So 193 minus 60 cash buffer in the bank. Now is that 133,000. Now we've got this property as property number 4. Let's assume that we don't do anything. We don't touch the equity. We let it sit there for another 2 months. So months goes by and we're at, let's say, 15 months now, right? We're getting 16 months. Then we buy another property. And this is a real life example of a house. Hopefully it pops up on screen. 575,000 in this scenario. We buy the property, we do a 10% deposit on this one. Let's say the bank says, can't do a 5, sorry, you have to do a 10. We do a 10. $58,000 for a 10% deposit. Stamp duty is at $31,000 in Victoria, because Victorian stamp duty is $3K for legal fees. And let's just round it up, we spent about $100K, right? So we're at $133,000 before now we take away $100K. We've only got $33,000 left. We bought the 5 properties. And let's say we're only about 18 months in. For those of you out there, you can buy property in rapid succession. Like I've bought 10 properties literally in the same week myself. In the last 6 months, I've bought roughly about 40 properties just myself. 40 properties in, I've seen clients buy 5 properties within 2 to 3 months as an example. And we've got about 4 months left to spare. So let's just say for the next 3 to 4 months, we go back and we try to get more equity out of the properties. Because remember, we only got equity out of property number 1 and 2 so far. We got 139K out before, and we got 40K out before. But we haven't got equity out of property number 3. And that was the one in Northcote, a 2-bedroom unit in Melbourne, which was bank valued at 550K before even purchase. Clients bought one in there. I bought one in there. It was a bulk deal, negotiated transaction. We get it valued at 550K. It was already valued at that. Let's do the math on that, 550K. And then we get a 90% loan of the new value. So that's 495K. 495K is the new loan. The old loan, remember, was 376. So we take 495, we minus 376, $119,000. We've just pulled that out. Then let's say at the same time, we've still got a few months left. We work with our broker. We get equity out of property number 4. We got it valued at 430, new loan of 430. Let's assume we only take it up to 90%. The old loan was 320. The new loan minus the cash out, we take out $67,000. Back up 104 plus 119, that's $223,000. Because remember, we had $33,000. So let's do the numbers again. We had $33K remaining. And let's assume that from this point on, they didn't save any more money, right? They didn't save any more money. Let's forget about the savings for now. But we had $33K remaining from that. We went back and got $119 equity out of this property. So 33 plus 119 is 153. Then we got 67K out of this property. So we've got 223,000 cash back in our account. Yes, we had to pay 10K of LMI here, 10K of LMI there, 10K. Although they're, so let's take the 223 minus 43 is still 176K, which basically means we've bought 5 properties. We've done it well within 2 years. We took equity out of 1, 2, 3, and 4. Now, bear in mind, we haven't even touched equity in number 5 yet. In essentially, within the last 2 years, we used 150K to buy 5 properties. And at the end of it, we've got 150,000 plus excess cash back, like 176K. So within 2 years, we bought 5 properties, used 150K, leapfrogged one property to the next, took the equity out because we did it strategically. We bought them below, below value, markets that were growing, good cash flow, undervalued, so on and so forth, in the right pockets, which were exactly how I built my portfolio, right? There's a full formula and strategy. Like there's a lot to this. Every single day, people are doing this all the time. Can you not see how exciting and how crazy this strategy is? Before I move on to the next part of this video, if you haven't read this book here yet, 30 Properties Before 30, you need to get it. This is absolutely free. Click on the link somewhere around this video. You can download the PDF for free, or if you actually want the physical book, it's not for the tight asses out there, but you actually have to spend $8 only. So $8 is just for the shipping and the handling. If you've read that book already, you haven't read this one, get this book, How to Buy 10 Properties Fast. It shows you a bunch of real life examples on how you can buy 10 properties within 2 years, 3 years, 5 years, 10 years, based on different scenarios. Let's talk about the cash flow of those properties. And I'm going to give you a real life example of what was here. So this one right here, I'm going to give you one example out of the 5, but they're all pretty similar. Now, the first property, if you might remember, is a 2-bedroom property in a suburb of Cloverdale in Perth. 2-bedroom, 2-bathroom, 1-car, very modern villa style unit. It was bought for $395,000, but for this example, I've done the interest components and I boosted them up to where the loans would roughly be after the equity was already taken out. So if anything, these cash flow sheets are even more conservative from what they are in real life. The loan, as an example, on that particular line, originally it was about 360,000 odd, and then the loan got bumped up to around, by memory, 450,000. So there was about 100K of equity there that we have to take into consideration, right? So these interest repayments right here are done off the higher amount or roughly in the middle there, okay? To give it to, for everyone out there, to know that, yes, when you take equity out, yes, the difference of interest. If you take 100K worth of interest out, that will cost you an extra amount of in interest per year. So if you take 100K out and the interest rate's 6.5%, well, then you're going to pay an extra 6,500 per year in interest, right? But this is taking into consideration that already. So that property there, council rates and water rates, long story short, combined around $2,200 per year, because the council rates for obviously it was a 2-bedroom, 2-bath, 1-car unit, $1,300 for the entire year, pretty good. And then the water rates, which again, water rates, I included them in this, but often the tenant pays for the water usage anyway. So it might even be less than $2,200, right? But I'm giving you the benefit of the doubt. Council and water, $2,200 per year, per annum. Insurance and strata, by memory, it was $1,800 for the strata, which included the building insurance, because it wasn't in a massive complex. It didn't have an elevator. It was only in a block of 10 or so, and it was a very, very low maintenance type of property. So strata includes insurance, $2,100 per year. And I've rounded that up as well. Management fees for the property manager who manage the property, roughly $2,000 per year. Landlord insurance like Terry Shear, EBM. If the tenant breaks something, if something happens, the tenant moves out, you lose rental income. Landlord insurance, it's only roughly $300, $400 per year. I've rounded up to $400 in this scenario just to, quiet the haters out there. For those of you that don't know, that usually I don't include miscellaneous repairs in a property like cash flow sheet, because some of them repairs could be covered under insurance if it was something was done by the tenant, as an example. So there's a lot of variables. But in this scenario, I've added an extra $500 every single year just as a buffer maintenance for insurance. But basically, if you're investing in property, you should have your own buffer. Like, it's not the property's fault if something happens to the property, or if the property, something breaks in the property. It could be the tenant's fault, because it could be your fault. Like, don't put that in the cash flow sheet. But I'm doing it for this scenario. The interest, let's say the interest per year is $25,000, right? That's about $480 roughly per week, based on interest only. For this scenario, we want to be doing interest only. Why? I'm not going to give you the full example because this is probably another 30-minute video. It's going to make it go even longer, but there's 1,000 other videos that I've created for you guys absolutely free that you can watch. But you go interest only because it's more important to be able to scale your portfolio quicker and faster and more efficiently. And the quicker you build that portfolio, which you're able to do better if on interest only, because you've got more cash flow coming in to service more loans and more cash flow coming through your bank account, literally. Adding up all the expenses right here, 2,000, 2,000, 2,000, 400, 500, and 2,500 bucks. That works out to be $32,200. And the rental income was $32,760. So this one, technically, yes, we are pre-tax cash flow positive 560 bucks per annum. Like many of you were saying, whoop-de-doo. And to me, the cash flow, I couldn't care less about the cash flow. From like 500 bucks a year, ain't gonna do much. Even if that was negative $2,000 a week. Now, remember in the example, the person is able to save 500 bucks a week. Even if this property, hypothetically, let's say the property is not positive, this one may be positive $500 per year. Let's say the other 4 properties are all negative $1,000 a year after all the expenses and things like that, before tax deductions. Now, I'm not even taking into consideration, tax deductions, negative gearing, depreciation. Depreciation, if you don't know what that is, watch one of my other videos to explain what that is. But this is all extra money you're going to get back at tax time, right? So let's assume though that each one of these properties is worst case scenario. Let's say worst case scenario, they're negative 2,000 bucks per annum. I just showed you one was positive 500 bucks per annum, but let's say they're negative $2,000 per annum for all the haters and the, people that are skeptical out there. Negative $2,000 per year. Over the course of a year, that's negative 10 grand per year, right? So that's negative $200 cash flow, pre-tax negative. I would definitely pay and hold 5 properties and only be $200, even $300 a week out of pocket, because if I'm able to save $500, the investment is better off to go into holding 5 assets, 5 properties that are growing in value. It's forced savings. It's better than having that cash in the bank. So that's one example. Right, so the next one that I want to talk to you about is the 5 properties that we just bought. Those 5 properties was worth a total value of $2.65 million. And against those loans, after we topped up all the loans, were roughly $2.293 million in loans. So that's how much the properties are worth, and that's what the actual loans are against them. Compound growth is a magical thing. Now, in Australia, the average capital growth rate is about, over the last 30 to 40 years, is about 7% throughout Australia. And we're talking metro cities and even other regions as well, but let's say 7%. I want to be more conservative with you. I want to be more conservative with you in this scenario, and we're only going to base this off 5% per annum. If the property portfolio is worth $2.65 million, after the first 12 months of owning that portfolio, 5% on 2.65 is $2.782 million. It's just jumped up over 120,000 bucks in 12 months. It's probably more than the person might be earning as a seller. Now, the next year, what's amazing is this compound growth, 5%. You're not getting 5% off owning 2.65. You're getting 5% of 2.782. So it compounds and gets bigger and bigger and faster and faster. Year 2, you're at 2.92 million. Year 3, 3,067,000. Year 4, 3.221 million. And year 5, you got 3.382 million. And remember, let's assume you were on interest-only loans for 5 years. If you take this right here, 3.82 minus 2.293, got over $1 million in equity in 5 years. And they usually double in value within 2.5 years. And this is not even saying they'll double in value. This is only saying you're going to go up literally 5% over 5 years. This is so conservative because I have hundreds, if not thousands of clients, which I've got them to portfolios of 3 million, 5 million, 10 million, 20 million bucks. I've helped them build that portfolio. And let's say we've got it at 2.65. And 3 years later, it's worth 6 million because we bought in markets right before they took off in that growth cycle and they had massive cash flow to be able to sustain it. And we bought them with already 10 to 20%, maybe 30% worth of equity in it from day one. So to get to 100%, if we bought it for 25% under what it was worth, it didn't need to grow 100%, it only needed to grow 75% to technically double. Because we're already 25, 30% there if you buy well on the way in. Well, that's one thing you get with property. Let me tell you that inflation has been around for hundreds and hundreds of years. Inflation isn't going away. It can go up, it can go down, it can go, faster and slower. Properties will always continue to be worth more and more over 5, 6, 7, 10, 15 years. Now remember, that's conservative. 5% per annum, not 7%. If it was 7%, it'd blitz it even more, even better. The next thing I want to talk to you about is you might be thinking about the cash flow. Like, Eddie, but it's not physically making me any money. It's only I can't use this money. And I want to answer that question, common question right now with you as well. The cash flow, as well as compound growth as an example, right? Well, let's finish this side first. Compound growth aspect. Let's give you a real life example of this. The property's worth, as an example, after 5 years, the property portfolio after 5 years, again, is worth $3.382 million. You've got $1 million in net equity. The debt's staying the same, right? So, because we've done 5 years interest only. Now, it looks a bit like this graph over here on my left. We bought the property, and this is the property going up in value. And then this is the property, this is the actual loan. Yes, for 5 years, this is a 5-year period, right? So what, 5 years. The loan hasn't moved. But you can do many different things here. You can do a new 5-year interest only if you want to maximize cash flow. And this is where the options a person has, which we'll go through in a second. Or if you just switch it over to principal and interest, then the loan will gradually start to go down and your equity will get bigger and bigger. And over 10 years after that, right? So this is only 5 years, then 10 years, your portfolio is worth $6.056 million. And remember, let's assume you just didn't buy any more property. I've worked with thousands of clients. They bought 5 and they're like, yep, that's cool. That's enough. No problem. Like, I'll be right in, 5 years, 10 years, 20 years. That's fine. Other people only buy 1 or 2. Many people want to go, more than that because they see the light. Like, this is an amazing strategy, and it's literally too good to, it seems too good to be true, but it is true, right? And that's why I'm all over TV and the media and all that kind of stuff. And we've got the best reviews and so on and so forth. So again, the loans are only 2.2. So in that scenario, you've got at least 4 million, 5 million worth of net equity there. But over the long term, if you did choose to if you chose this option, pay down and just switch to P&I and not do anything, over the years, that the portfolio keeps going up, and then the loan goes down, and then eventually you've got a portfolio worth 10, 15 million bucks, and the property has been paid off by someone else. The tenant is paying off the property. You are building an empire, and you're not even paying it off yourself. The tenant's liability is to pay the rent, and the rent is basically the payment that pays the mortgage. One question I want to answer out there, people say, what if all your tenants move out? Well, there's different strategies that you can put in place to ensure that never happens. And I've never had a property go vacant for more than maximum 1 to 2 weeks, because I'm buying in metro areas where the supply is low and the demand is high and so on and so forth. But again, you've got different lease terms. You can have them set on different leases. One could end this month, another one could end 7 months later, another one could end 6 months later, 3 months later. You could stagger the leases to ensure that then they never go vacant. Going back to the old thing, you've got landlord insurance. If it does go vacant or they abandon the property, landlord insurance, and will pay for the rental income. I want to talk to you about the cash flow perspective. These 5 properties that we bought on the other side of the board, the average rent on there was about $600 per week. $600 per week times 5 properties is roughly 156 in gross rental income per year for those said 5 properties, right? So let's assume down here that we're starting off at 156K. What's funny about this, as well as the average capital growth rate in Australia is 7%, we're doing it at 5. The average rental increase rate with inflation is usually between 3 to 5%. For this scenario, let's use 4% as an example. That's in there in the middle. This is conservative because I have bought properties where the rents in markets, because I bought them prior to a massive, explosion in that market and in population growth and all that kind of stuff, because I'm timing the market. Remember, market cycles can go like this, right? If you buy right here, by the time you get back to where you originally were, it could be 7 to 10 years. But if you're buying right at the bottom of the cycle and it goes up, you literally exponentially smash your goals and your cash flow and your growth and equity goes through the roof. And that's how you can double a property in often 2 to 3 years. 4% per annum. Let's do the math on that. After 5 years, your properties aren't renting for 156K combined anymore. They're renting for 189,000. We've already increased net cash flow by over $30,000 per year. That's $600 roughly, give or take $600 per week. After 5 years, your portfolio, even if it hasn't done anything and it's going at conservative 4% rental increase, remember the debt stayed the same, remember? This is the rents increasing, similar to that graph over there. This is the expenses. After you took your equity out the first time, your expenses generally stay the same. You can see this is slightly going up, but nowhere near as much as the actual rent goes up, right? Because you've got, what are your expenses? Again, these things right here. Council rates, insurance, management fees, landlord insurance, repairs, and interest. Yes, all that stuff can go up with percentages, with inflation over time, but there's no way that it goes up as much as rental increases go up. I bought my first property back in like 2008, and the council rates had barely moved. Back then, they were like $1,200 per year for a 2-bedroom unit in the Central Coast. And now they're like, it was this 12, 13 years later, 10% higher. Like they're like $1,500 per year. So they don't go up that much at all. So, yes, they might go up a fraction, but your rent's what really, what goes up the quickest. So 5 years, you've got at least 30,000. And bear in mind, this right here, if I didn't cover it before, assuming the average interest rate is 6.5%. Rates just got cut recently, and I believe they will be cut again in the very near future. But interest rates, you can get a interest rate on a mortgage on a loan for an investment property around 6.5, sometimes in between low 6s to 7s to 8s and so on and so forth. Yes, you can get high interest rates if you do a 5% deposit or 10% deposit or whatever it is, a small deposit. But for this scenario, let's just keep it simple, 6.5%. There's obviously going to be variances here or there, but let's try to be positive about it, guys. All right, let's try to be like, oh, but you said this is 1%. Let's try to relax and believe, and that obviously this is legit stuff. What happens after 10 years? 10 years, and this is at 4% compound growth of rental increases. 10 years, your rental income has gone to $230,000 per year, and that's just for those 5 properties. Like, I would encourage people not to stop at 5 properties and buy 7, 10, 15 properties. If you're an investor, you make the most amount of money as possible. Like, why wouldn't you? Let's assume you just stopped at 5. And remember, you had all that other cash left in your bank as you pulled out the equity. And remember, your expenses were the same. So it's gone from 136 to 200K. 10 years, you got a 100K passive income stream. 100K, that's $2,000 per week. And the loans are going down now. Let's assume they've switched over to principal and interest. Yes, the principal and interest would have affected that, but that's where rental increases happen. Even if you switch your portfolio from interest only to principal and interest, yes, it might bump up the repayments by 10, 20K a year as an example across those 5 properties, but your rent's already jumped up 30 to now 100K. It all washes out the same. Just like when I went on national TV and said, Eddie owns 100 properties, he's going to go broke because interest rates are going from 2% to 7%. What naturally happened? What naturally happened was that the rents got pushed up in line with the market because all investors started increasing their rents, and inflation was obviously going through the roof. So that pushed the rents up. I didn't push the rents up. Inflation pushed the rents up. This is how, in essence, in legit theory and life, that cash flow grows over time just from doing nothing at all. And that's just 5. Now, what can you do with the property portfolio once you have it? There's many things you can do with it. You could choose to, let's assume like 10 years has gone by, your property portfolio is worth $6 million. Your loans of, still, let's say they're back then, but you've got $4 million in equity. You could just literally sell them all if you wanted to. You don't have to, but you've got options. Like, I got options, a shitload of options now. I've got 150 plus options. Anytime something happens, like, I could just sell this property or get rid of this one or refinance that one or whatever. I'll pull out $5 million here, $10 million there, $20 million there, but I can push to do more, exciting stuff. So you could sell them all, or you could, next thing, obvious, you could sell some. You could sell, hypothetically, if you did it correctly, you could sell, there's 5 of them. Let's say, now they're worth 6 million, but you've only got, and 6 million, there's 5 of them. So let's just say, assume they're worth 900K each. You could sell, let's say, 2 of them and then pay the others outright. So you have 3 properties, or worst case, have 2 owned outright. But by then, after 10 years, remember, the rents are probably going to be not 600 a week, they're going to be 1,000 a week. So then you had 2 properties. Let's say you have two properties, right? And they're owned outright because you sold the other 2 or 3 as an example. Well, I'm being conservative. You probably only just sell 2 and pay the other 3 out. But say you sell 3 and pay 2 out, then you got 2 properties, right? You're a happy man or woman, and they're owned outright. And because the last 5, 7, 10 years has gone by, the rents on now are probably around $1,100 a week, and you got $2,200 as an example per week, which is coming in with no debt against it. And it's going up in value and so on and so forth. So you could sell all of them, you could sell some, or you could just pay down. We've already done this scenario, but you could just have those 5 properties literally just start paying themselves off. And just like this, the rent's going up, the value's going up, and the loan's going down, and then you'd be mortgage free. If you started in your 30s, you're going to be mortgage free at, 50, 55, worst case 60. It's not a bad scenario. But that's if you only bought 5 properties. You should buy more than that, but start off with 5, all right? Start off with 5. Or another option is you could just redraw the equity. Let's say you've got, even started going back to year 5, we've been doing it 5 years, right? Your portfolio is worth 3.3 million. Your loan's only at that. Redraw equity up to 80%. Have the equity sitting in an offset account, and you got tax-free money sitting in an offset account, 800 grand, $1 million worth of equity sitting in an account, and you can do whatever you want with it. Go buy a Ferrari, go buy a Lambo. I wouldn't buy that shit. I buy older, more classic cars that I think that actually go up in value. Got a Mustang, got a Pontiac, other stuff like that. So I'd buy shit that goes up in value. Or just have the $1 million in there and you're an offset account. But I personally just do the last one. I wouldn't do that. I just do the last one. I just buy more property. Like if something works, don't change it. Just buy more property and make more money. All right, guys, real quick before you go, I want to give you the answers to 6 different questions that I found the most common comments below were. The first question, if you take out equity from the property, will the property go negative? And the answer is yes, sometimes it can go negative. But if we're talking about cash flow and building a property portfolio, you make your millions through the equity and the growth from that property. If you have a property, let's say you take equity out, 100K out, and then it pushes it from being neutral cash flow, to then it's negative $6,500 per year. Wow. But over that time, remember, rental increases happen. So I've done this before. I've took out, let's say hypothetically 100K worth of equity. It changed my repayments to an extra $6,000 off 6% interest per year. So yes, it was negative 6,000. But what happens to the rental income? Within 1, 2, 3 years, the rental income is enough to cover that. And not only that, even if each property is hypothetically going to cost you 5K per year out of pocket. Remember, we did this and we did it off, they're costing you $2,000. Let's say they're costing you $5,000 per year out of pocket to hold. In this original example, we said, this is for someone good that can save $500 a week as an example, right? If you're saving $500 a week, that's $25,000 per year. Even if these properties were costing you, had 5 of them, and they were costing you $5,000 negative cash flow per year to hold, well then, that's still the $500 per week that you were putting away in savings. I would rather hold a portfolio because yes, you'll get negative gearing deductions and so on and so forth, and you'll be able to claim deductions on all the depreciation benefits and all that amazing stuff, right? Where you get a massive tax return back. I haven't even included the tax returns that you're going to get back and be able to make extra money that way. But I would rather, have the property be negative $25,000, the portfolio be negative $20,000 a year negative, than having $20,000 a year going to an account doing nothing. Because that's the cost for owning a portfolio that is going up with compound interest from 2.6 million to 3.8 million to 10 million. So yes, if you take out equity, sometimes it is, but I've already factored that in when we did these scenarios on thing. I factored in if you take the equity out already. Question 2, a big one. How do you keep servicing and getting the borrowing capacity for these loans? The last video that I did with how to buy 10 properties in 3 years, everyone asked. 1, in order to continue borrowing money and getting loans from banks, there is different strategies that you can use. You can buy properties in trusts or companies or self-managed super funds, and different banks have different policies. So if you're out there and you're about to be negative saying, oh, but my bank said I can't, I bought 2 properties and I went to, Westpac as an example, and they said I can't borrow anymore. Well, try another bank. Try another broker. Talk to 5, 10 mortgage brokers, because in Australia, people, there is over at least 50 to probably 100 different lenders. And each of these lenders have different policies. And I know a lot of them off the back, in my head and off the back of my hand. I know if I can't get finance with this bank because of this particular reason, then this particular bank over here doesn't follow that exact policy for that particular situation. So I can pivot and go to this particular bank. So there is always a way to move forward. Now, I want to be clear with you that in that scenario, a person had $150,000 in cash. Let's say that person was on, hypothetically, 150K per annum in income. Like, I've seen people do it on 80K worth of income. I've bought my first 14 properties and I was only on about $60,000. So this can be done if you're on 60,000, 70,000, under 100K. Now, if you're earning more money, obviously it's better. Obviously it's advantageous because you can save more money quicker. The next question: what happens if the market crashes? Eddie, you're telling me to go out and buy. Well, I'm not telling you to do it. There's no financial advice, remember. What if we buy 3 million worth of property and the market crashes? Long story short, in Australia, the biggest decline was during the GFC. And even then, the max decline that property prices saw, if you look on, data, statistics and all that, was roughly 10%. So and that's part of the strategy. If we're buying a property that is under what it's worth, let's say we're getting it 10 to 20% below what it's worth, or even 5%, and the market's growing, and the market's gone up 30%, right? Let's say year 3, we bought it for 2.65 million. Then year 3, the GFC happens and 10%, the GFC happens or whatever, and the market goes down by 10%. Knock out 10% off that, 3 million, take off 10%, you're at 2.7. Your properties are worth, they've dropped 10% as a worst case scenario, which is not going to happen, by the way. If you buy in the right area at the right time of the cycle, you're buying below replacement cost of these properties anyway. So your market, let's say the market does crash 10%, it goes down 2.7. Well, you're still worth more. It's still worth more than what you pay, and your loans are only at 2.293. So you still got 500K worth of equity in this scenario. So those who are too, risk adverse or whatever it is, fortune favors the bold, right? Like, the richest people and the most wealthiest people in the planet take calculated risk. But to me, this strategy is not risky at all. This strategy, to me, it is more risky sitting on the sidelines and doing absolutely nothing, because the person that started with this scenario only had 150K in a bank over 5 years would barely be worth, and you always spend the money. By not buying property, it is risky to not buy property. By not taking action, it is very, very risky, because all you're doing is guaranteeing that you're going to be the average and you're going to be following the herd and you're not going to get ahead. Taking no action is a risk. And last question: what happens if the interest rates go up? Now, we've already seen interest rates go from 1.99 to 6.5%, 7%. So we've already seen it. And I'm still standing, right? We're all still standing. The property investors that have followed my strategy, we're still kicking goals, and because what happens, I explained it before, I'm not going to get into it, but when the interest rates go up, that's obviously because inflation is rampant and they're trying to monitor inflation within Australia. And with inflation, the rents go up. The rents go up and everything balances out. So if you need help with whether it's finding a property, getting finance to buy an investment property, whether it's anything at all property investment related, click on the link, jump to the website, inquire with us. We'll be able to guide you and help you and kick ass in property investing. Thank you so much. I'll see you soon.